Hi everyone. Let's spend a few moments distinguishing among the three basic forms of business organizations, and let's describe the advantages and disadvantages of each. Okay, first we have proprietorships, then we have partnerships, and we have corporations. Let's talk a little about sole proprietorships. A sole proprietorship is a business owned by a single individual. It certainly has some advantages. It's easy and inexpensive to organize, and that's probably why sole proprietorships are the most common type of business that we find in the United States. It also allows the owners to have a great deal of independence, since they essentially get to call all the shots in their own business. They're the one and only owner. Now, there's also some disadvantages with the sole proprietorship, and the most significant disadvantage is the idea of unlimited liability, which means that the obligations of the business are not separate and distinct from the obligations or the assets of the individual. So in the event they fail to meet their obligations, creditors, which are the people that are due something from those businesses, may come after those sole proprietorships, and they may go after the assets of the business as well as the assets of the sole proprietor running the business, the personal assets, to fulfill their obligations. Okay, they also have limited access to capital. If your purpose is to create a billion-dollar organization, a sole proprietorship will probably not get you there, because the capital markets and others willing to lend money is greatly reduced in a sole proprietorship as opposed to, say, a corporation. And the slide likes to point out that many sole proprietors or sole proprietorships sometimes subject the owners to long hours. Now, of course, that isn't the case in every situation, but certainly that's true in a number of sole proprietorship businesses. Okay, let's talk a little bit about partnerships. Partnerships are businesses with two or more owners. Now, we're concerned with partnerships that operate a business for operating a profit. They are also inexpensive and relatively easy to organize. You don't have to have a partnership agreement, but it's a pretty good idea to have one, at least so you understand how profits and losses will be split between the people that have decided to form a business and operate one as a partnership. Okay, now there's some disadvantages in a partnership, and at this point we're really concerned with what's known as a general partnership. There's unlimited liability, which we've talked about before with sole proprietorships. And partnerships introduce a concept called conflict. It's also known as the agency problem. And it is the idea that at times people do not act in the best interest of the organizations they work for. They act in the best interest of themselves. So in the case of a partnership, the situation may arise where what's good for one partner may not be what's in the best interest of the partnership as a whole. So that conflict comes into play in a partnership. Now there's also two additional new forms of partnerships. One's called a limited partnership. The other is called a limited liability partnership. In the cases where we have limited partners, there may be limited liability. That's the key with the word limited there. But in every one of their businesses, if it's a limited partnership, there still must be one general partner. Now let's talk about corporations. Okay, corporations are a separate legal entity from their owners, and they have stock. Now, they're not as easy to set up. They have shareholders, but usually there has to be the work of a corporate attorney to set up articles of incorporation. They're run by board of directors. They pay dividends. Dividends is the return that are paid to the shareholders. They don't always pay dividends, but lots of corporations do. Lots of times in the early growth stages, corporations would prefer to hang on to all of the cash they have to support their growth, and so we don't see a lot of dividend-paying stocks in the early years of corporations that are seeing high growth. That's not always the case, but that's in the case in a majority of cases. Okay, we've also seen a new type of corporation that's made its way in the United States, and it's a limited liability corporation. Okay, the advantage of a limited liability corporation is that it is a corporation and has the advantages of the limited liability, but it is taxed in the way that a sole proprietorship is taxed or a partnership, so it avoids double taxation. Now, let me explain double taxation. When a corporation is organized as a for-profit corporation, it is subject to corporate income taxes. Any income that it makes must be shared with the government, and that sharing is the corporate income tax. Then when the corporation pays dividends, the amount of cash dividends that are paid to the shareholders are taxed to the shareholders individually. So here we've seen the idea of double taxation, because essentially the same income is taxed twice. All right, let's talk a little bit about stakeholders in a business. Stakeholders are essentially people interested in the affairs of the business. They consist of customers, employees, stockholders, competitors, the government, and the community in which the business operates.